Hey everyone, in today's video, we're going to talk about an often overlooked topic surrounding Roth conversion strategies. And that's where will you pay the taxes for that conversion out of? Usually each retiree has a few different sources that they can eventually pay those taxes out of. Some retirees have some restrictions for where they can and can't pay those taxes out of. So in this video, we're going to be talking about an alternative option to paying Roth conversion taxes, specifically for those that are less than 59 and a half. Okay, and this alternative option is going to be puzzling to some of you because it's paying conversion taxes out of a Roth IRA. Now, before we get into the content, if you don't know, my name is Eric Scheidock. I'm the head of research here at Safeguard Wealth Management. I'm also a partner here at Safeguard Wealth Management. I want to take a second just to thank everyone that's part of our growing and awesome community here on the Safeguard Wealth Management YouTube channel. You guys are fantastic. Thank you so much for taking time out of your day each and every week in order to watch these videos, gain value in order to improve your retirement. For those that aren't yet part of this community, it's as simple as hitting the subscribe button down below. It's absolutely free, and you'll be notified of all future videos that we release on how to build a better retirement, a stronger retirement for your future. Okay, so let's get into it. So right off the bat, I'm going to be referencing a video that we did last week, and that video was in regards to miscalculations and mistakes that people make in calculating how much they should convert, where should they pay the taxes from. So I highly recommend you watch that video. I'll link to that video in the right-hand corner. We're going to be referencing that a lot throughout this video. So you have a few options for where you can pay taxes out of from a conversion. Okay, the optimal option, if you have this option, is to pay taxes out of a savings account or a non-qualified account. So if you have, again, a savings account where you have a lot of cash built up that's earning, let's say, 0.25%. Paying taxes out of that savings account can be beneficial in a lot of ways. One, you're allowing the full converted amount to now go to a Roth IRA. It's going to be tax protected. It's going to be invested, and you're taking money out of a less tax preference account that's earning next to nothing. So this is the optimal case. It's the case that, again, most people look at and think this is the only option. This is not the only option to pay taxes out of savings or a non-qualified account. Last week, we talked about how a base case option, your neutral option, should be to pay taxes out of the conversion. Now, again, if you can pay taxes out of the saving, that's better. But paying taxes out of the conversion is your base case. It's your neutral option. It's totally fine for most retirees. Okay, now most retirees think if I'm paying taxes out of the conversion, I'm eliminating the value of the conversion. That's not the case. Okay, again, this is your base case. I make the case again in this last video last week. Highly recommend checking out that video. I'll link to it in the description as well. Okay. And again, what would that look like if you're making a $100,000 conversion, paying 22% taxes? You're actually only converting $78,000 and you're paying that $22,000 out of that conversion to taxes. Now, the question that arises here is what happens if you're younger than 59 and a half and you don't have the savings available? Okay, so both of these options are now eliminated. If you're younger than 59 and a half and you don't have the savings available, okay, if you don't have the savings available, obviously we can't pay conversion taxes out of a savings account that we, again, don't have enough built up in. If we're younger than 59 and a half, if we pay taxes out of the conversion, the taxes that we take will be counted as a distribution. So younger than 59 and a half, that means we're paying a 10% penalty in addition to the taxes that we'd be paying for that conversion. So again, in most cases, that's going to eliminate the value of the conversion. So that's off the table. So what options do you have? Well, in last week's video, we talked about this idea of tax equivalency. Okay, how two situations, despite them being different as far as the logistics of the situation, can be tax equivalent. Okay, my case to you today, and it might be puzzling to some viewers, paying the taxes out of your Roth IRA is tax equivalent to paying the taxes out of your conversion. And let me show you an example. Okay, let me show you a tax equivalency example for what I mean. So let's say we're making a $70,000 conversion. Our taxes are going to be $15,400 for that conversion. Okay. So if we pay taxes over here out of the conversion, what's going to happen? Well, we're performing a $70,000 conversion. We're paying $15,400 in taxes, which means we're only actually converting $54,600 because, again, we're paying the taxes out of the conversion. Okay, versus let's say that we had a $70,000 conversion, but now we're paying the taxes out of our Roth IRA. Okay, so now the full $70,000 is being converted. Okay, again, because we're not paying taxes out of the conversion, now we're paying taxes out of the Roth IRA. And over here, we're going to withdraw the $15,400 from the Roth IRA. Okay, so how are these tax equivalent? Well, if we think about it, there's a lot of different reasons we want to perform a conversion. The main reason for most people is to minimize RMDs, minimize tax deferred accounts for down the road. Okay, in both cases, we are taking $70,000 from our tax deferred account. So we're equalizing out the same amount that we're minimizing tax deferred accounts and RMDs. Okay, in both cases, we're paying $15,400 in taxes out of our Roth IRA. Okay, again, we're paying this pre the conversion, but it's still, again, a $70,000 conversion that would end up being in a Roth IRA that we're now taking this money out of. So again, it's equivalent to taking that same money out of a Roth IRA. In this example, we're actually taking the money out of the Roth IRA. So the same amount is being actually added to the Roth IRA. At the end of the day, at the end of these two examples, we have the same amount in Roth, and then we have the same amount that we took from a tax deferred account. Okay, we paid the same amount in taxes in both examples. So these are tax equivalent. Now, I'd be remiss if I didn't mention, though, there are some ancillary changes that we'll mention here in a sec that are some details that matter. Okay. But again, it's important to know that whether we pay the taxes out of the conversion, which again we said is the base case in last week's video, or we pay the taxes out of the Roth IRA, those are tax equivalent. Okay, so let's go over here and talk about withdrawing from a Roth IRA. So prior to 59.5, when you withdraw from a Roth IRA, you still have restrictions. Okay, but those are varying restrictions. Okay, so let's look over here. We have a $150,000 Roth IRA. And we have some few things that make up this $150,000 Roth IRA. We have contributions. We have a prior conversion that this person performed a few years earlier. And then we have earnings. So the money that was invested, it grew, and there's $75,000 in earnings out of this $150,000 Roth IRA. Now I'm going to draw a line here. And this line, okay, below this line, this is fully accessible money at any point in time, regardless of any 5-year rule. Okay, so if this person had $47,000 in contributions through the year, they can access this money at any point in time, whether they're 20 years old or whether they're 55 or whether they're 70 years old. This is fully accessible money without penalty. So this is the portion where we would want to pay the Roth conversion taxes out of. Outside of this portion of contributions, again, it kind of eliminates the benefit of paying conversion taxes out of the Roth because we're paying a penalty now. So again, this is the money that we would want to pay those conversion taxes out of. In a Roth ordering rule, where the IRS orders, if you take money from a Roth, where is that first coming from? First, it comes from contributions. Then it comes from any prior conversions. And lastly, it comes from earnings. Now, in this person's example, they performed a conversion, let's say 2 years ago, of $28,000. Now, we know because of the 5-year rule, because they're under 59.5, they're going to have to wait either until they're 59.5 or 5 years ends in order to access this money without penalty. Again, I'll link to a video in the top right-hand corner where we talk about the varying 5 years rules with a Roth IRA. And then finally, what would be taken out last and what you don't want to take out of prior to 59.5 is these earnings. Okay. But these contributions down here are fully accessible. So it's very important to know your numbers. How much do you have in contributions out of your Roth that you could access at any time? How much do you have in prior conversions? And are you past that 5-year rule, or at least 59.5? And then finally, how much do you have in earnings? It's important to know your numbers. Now, I will also say, again, talking about the ancillary details that change on top of that tax equivalency, this requires some careful planning. Because if we think about it, we're taking freely accessible money, freely accessible dollars, and we're essentially locking this money up, this conversion up for 5 years or until you reach age 59.5, whichever comes first. So this creates an important situation where we need to plan carefully. Why is that? Okay, know your timelines and know your goals with the conversion. Okay, let's say you're 55 years old and you just retired. Okay, and you want to perform a conversion and you're planning on paying those conversion taxes out of the Roth. Well, you want to make sure that you're not planning on using this contribution amount, this Roth amount, to try to earn a subsidy for ACA insurance. Because again, then you probably don't want to perform a conversion paying the taxes out of the Roth IRA because we need this Roth IRA money for other reasons. And remember, we're taking dollars, we're taking contributions that could be fully accessible, and we're essentially locking that money up within a conversion. So again, as far as the tax equivalency, the same amount of money is leaving a tax deferred account. Okay, we're having the same amount that's eventually into the Roth, but the slight difference is that now the money that's in the Roth, if we're paying the taxes out of the Roth IRA, is now locked up versus before if we were able to pay it out of the conversion, that money wouldn't be locked up in the Roth. Okay. So again, important to know, especially for those before age 59.5. Again, you need to know what else is going on in your situation. You may need this contribution money for other reasons. Okay, but if we think about it in general, what are we doing? Okay, let's take a scenario where we're making a $50,000 conversion and we're paying $10,000 in taxes that we owe. We can essentially use our Roth IRA take $10,000 from our Roth IRA in order to add $50,000. Okay, so again, in this idea of minimizing RMDs, improving our tax situation for the future, I would urge all of you, if you're younger than 59 and a half, don't be scared of paying those taxes out of the Roth IRA. Again, it's a tax equivalent scenario, and you're still minimizing RMDs, and you're still adding to that Roth IRA. It's still, again, an equivalent fine scenario. Don't be afraid to pay those conversion taxes out of that Roth IRA. The only kind of disclaimer that I will have here is know the goal of the conversion and know what else is going on in your situation. If you're needing to, again, try to earn a subsidy here, okay, you might need this freely accessible money. You might not want to do that conversion. So again, hopefully this was interesting. Hopefully it offered an alternative view for paying taxes or for paying conversion taxes, especially for those prior than 59 and a half. If you haven't accessed or if you haven't watched our video last week, talking about tax equivalency, talking about where you should pay conversions from and some common mistakes that people make, I highly, highly, highly recommend watching that video. Again, we'll link to it right over here on this screen. Again, always remember, you don't need more money. You need a better plan. Don't forget to subscribe to this awesome community we have. Thanks for those that are consistently watching. We'll see you in the next video. Bye.